And good afternoon. My name is Randy Price. He is Matt Price. Together, we are a big part of the Price Group, and today we are with you. Thank you for joining us. We're going to talk about retirement, specifically the planning timeline. There's some specifics to be aware of as you get closer to retirement, and we want to make this easy for you. So for the next 35-40 minutes, we're going to go through some information. If you have questions, feel free to hit the questions and give us something specifically for you to talk about. But as we move forward here, we're going to talk about who are we? We are the Price Group, family owned and operated, 45 years plus experience. Probably the most important thing for any person looking to potentially hire an advisor or a wealth coach is making sure they do indeed follow a fiduciary standard night and day with regards to what the client is, how the client is treated. And we do have a specific niche that we follow. 82% of our clients approximately are of retirement age. So anyway, as we move forward, Matt, tell us a little bit about the Price Group, please.
Yeah, both Randy and I certified financial planners. We have a third certified financial planner on the team as well, Maddie Kearns. Randy and I went to the Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. We think education is really important. I think most everyone on the webinar today is on our retirement insider email, but we try to over communicate, especially when markets are moving lower. We really ramp up our communication as it pertains to the market. And for clients, that means talking specifically about investment models, what clients own, if and when we're making decisions, and why we're making those decisions. Randy has gotten quite a few awards from Barron's, Forbes, Financial Times. Our team just this year was also mentioned by Forbes as a best in state wealth management team, which we were humbled by. Our firm, Steward Partners, based off the biblical definition of stewardship, at the end of last year, over $32 billion of assets, 40-something offices across the country. We have two custodians just being a fancy term where client assets are held. Raymond James being the main one, the other one is Pershing, but they've been a great vendor, a great partner of ours, and a very fiscally conservative company, which we find appealing.
So what are we going to talk about today? Number one, retirement planning if you're 2 to 5 years out. Number two, retirement planning less than 1 year out. And then drum roll, please, you're retired. And we're also going to cover some information on planning after retirement. So let's start out. You're 2 to 5 years out. You're thinking, you're dreaming, you're looking forward to that. What do we want to do? Well, the old adage, look before you leap, certainly comes to mind. We think creating a wealth and investment plan for your retirement is critical. Let me say that again, is critical. If the plan is not written down, it is not a plan. Hoping is not a plan. We want to develop a family index number. We'll talk a little bit more about that, but that's important also as you consider how much income you're going to need for retirement. But you're still working, so you want to evaluate your retirement plan contributions and also your allocations to your 401k, profit sharing plan, etc. We find a lot of people who get to retirement and they say, I'm a conservative investor, and we look at the 401k or the profit sharing plan statement and they're way, way heavy in equities. So, and that sort of leads to the fourth point is, what would be the consequences of a negative year in the stock market and its effect on your retirement date and your standard of living? No one in 2007 expected 2008, and nobody in 2021 said 2022 is going to be a bad year. COVID snuck up on us as well. So from a standpoint of looking at all of this, it's very important to start a glide path, to talk in the airplane terms, to get where you want to be. Potentially the worst part of having a negative year right in the couple of years before your retirement is it sort of takes some of the fun and the planning out of that, and you start to have some worry and some concerns. We want to alleviate that for you. And we think 2 to 5 years out, you look at consulting or hiring a qualified, keyword qualified advisor team who specializes in retirement planning. So a lot of people come to us and they have a spreadsheet and they're really proud. We've seen some spreadsheets that literally take up almost the whole table. And but a spreadsheet only has static assumptions. Walk through with me here, if you would please, on this slide. Beginning assets of $100,000. There's 4 boxes. Average return 7%. Inflation's 3%. So we're going to take in year 1 a negative rate of return, minus 15. We're going to spread in some 7% rates of return, and then we're going to end in year 10 with 29%. What happens? Again, you start with 100,000, you end with $188,399. Congratulations. So we're going to flip that on the bottom left, where we start out with a positive return on the top, year 1, and we're going to put 7% in the middle, and then you're going to have a negative 10% in year 10. And look what happens. You end up with the same number, $188,399. Randy, Matt, this is pretty boring. What are you getting to? Well, let's go to the top right. We're going to start a distribution, a withdrawal of $10,000 from your account. Again, we're going to front load the negative 15% rate of return in these same assumptions. And sad to say, you run out of money somewhere between year 9 and year 10. Bottom right, we load the positive 29% rate of return in year 1 and the negative return of negative 15% in year 10, and you're still left with $52,749. The moral of this story is the sequence of returns can and will have a dramatic effect in your returns when you're in the distribution phase. Now, here's the issue. You've been in the accumulation phase for what, 20, 30, 40 years. And so you're used to getting your 401k statement. It's probably grown. You've been adding money to it. The company's been matching, hopefully. And but now you're in different territory. You've gone from accumulation to distribution. The rules are different. The expectations are different, and the planning should be different. And there's where we say the spreadsheet is not adequate. So bottom line, you need more than just a quote investment guy. You need a wealth coach. Some of you may be familiar with Benjamin Graham. He was Warren Buffett's mentor, but his quote is, the best way to measure your investment success is not whether you're beating the market, but about whether you're putting in a financial plan and behavioral discipline that are likely to get where you want to go. The Price Group, we believe in holistic wealth planning, holistic financial planning, holistic retirement planning, where we take into account retirement, investments, insurance, cash flow, estate planning, tax planning, goals, dreams, and aspirations. And so it's very important to take all this, again, part of the planning process. Again, what we would say is our secret sauce, and something that we think you should be very interested in at this stage. Again, you're 2 to 5 years out. So Matt, tell us, what should a financial plan include?
Yeah, Randy just hit a few of the highlights, but we said earlier, retirement is not an event, it's an ongoing process. This is something that we don't just check a box and do it once prior to retiring, but for clients, we're updating what we call our Live Well plan, at least on an annual basis, answering the question, are we ahead of track, are we behind track, or maybe are we right on track? What kind of specifically this would include in this retirement roadmap? How much can we spend in retirement? How long will your money last? A key consideration that we'll talk about here on the next slide in a little more detail is the family index number. What rate of return do you need in retirement? And then the kind of thing that everyone has been investing, like Randy said, for 20, 30, 40 years to grow money. But how do we do that to produce income? And this is not a webinar to try to sell you some expensive annuity, but we are looking for ways to create systematic, reoccurring, hopefully increasing income from dividend stock portfolios, fixed income portfolios, for certain qualified investors, incorporating some private credit into that. So it's more of a everything coming together in a cohesive fashion under this Live Well plan umbrella. So a little bit more on that family index number. What rate of return do you need? And how do I get there with the least amount of risk? We're going to define there as reaching your mid-90s, still having money left in your portfolio. Some families leaving an inheritance to the next generation is really important. Some families will say, I want the check to the undertaker to bounce. Whether you fall into one of those two categories or somewhere in the middle, that's something we want to account for. And so unless a family would tell us otherwise, our goal in retirement is to take the least amount of risk to be quote unquote successful. If we want to step on the gas for the benefit of the next generation, that's possible. We do that for a number of families, but we just want to make sure that we're doing that in an affirmative manner, meaning we've thought that through and we've actively made the decision to do that. So this family index number is part of how we track progress for clients. In addition to monthly statements, we send clients a quarterly performance summary. So it tells them how every strategy is doing, but then it piles it all together and it tracks it on one graph against the family index number. So it kind of replaces, are we outperforming some arbitrary index, to are we meeting the goals that we originally set out to meet prior to retirement with your group? And we've had a kind of a resounding yes on that. Clients really like this type of reporting that a lot of them have said they haven't seen elsewhere. So sometimes we talk in high level terms. You know, we need a wealth plan. What we try to do in these presentations is we try to have a few actionable items for you to actually go back to your work desk and implement, if that makes sense to you. The first of the two ideas we have today is an alternative to a Roth IRA contribution, sometimes referred to as a backdoor Roth contribution. Let me go over this kind of quickly, and we're happy to answer questions on this in more detail offline if you have them. But what you can do if you're making too much money and you've been phased out of putting money into a Roth IRA, you can add money to a traditional IRA. That is, this is key, non-deductible, meaning you don't get a deduction on your tax return for that. Now, the very next day, the next week, whenever it is, you convert that into a Roth IRA. During that conversion, you're only going to pay taxes on the gain from the contribution to the conversion. Now, if you made the contribution on a Monday, you did the conversion on a Tuesday, there's been no time to have a gain. So there's no taxes owed in that situation. Step 3, this is where you can stub your toe. We need to be careful about what we call the pro rata rule. And that has to do with any other pre-existing IRAs that you might have. So if you have a $1 million IRA held elsewhere, and you want to do this conversion of $7,000 round numbers, you have to take 7 as a percentage of 1,007,000, and that would be the tax-free amount. Bottom line is this: the strategy is not nearly as lucrative or interesting if you have other IRA accounts. However, if you have money in a 401k account, this strategy still should work. Obviously, we're not CPAs. We don't give tax advice, so run that by your CPA, but that's our understanding of the rule. And it's a great way when clients are making a lot of money above the limits to actually add money to a Roth IRA, which by definition is the best savings vehicle from a standpoint. The money doesn't grow tax deferred, it grows tax free.
Tax free is good.
Tax free is good, you're right. Second idea is maybe the first cousin to that. A lot of the 401k plans available in the open market for some larger integrated oil companies have an after-tax option. And so this is an alternative way to, in the Roth 401k, to get more money into the Roth. What we see is a lot of people will max out the Roth portion of their 401k, which if you're under the age 50, comes in around $21,000, $22,000 this year. You get that catch-up contribution of round numbers about $7,000 to $8,000 this year. On top of that, and this is contingent upon the 401k governing documents. So check with your custodian or your HR to confirm you can do this. But you can add a after-tax contribution, and then whether it's once a year within the plan or at retirement, the contribution piece you can also roll into a Roth IRA. So another good backdoor way for you to get some additional dollars into a Roth leading up to retirement.
And again, we're 2 to 5 years out, and you're wanting to do the planning and become more, if you will, aware of the constraints and the opportunities available for your company benefits. Well, Matt, a risk budget is so critical. Let's look at what percentage are you invested in stocks? Is that important?
Yeah, it in your 20s, 30s, maybe even in your 40s, you could answer that question no, because you're not touching this money for another decade or two. But the closer you do get in retirement, this 2 to 5 years out, we think the answer becomes increasingly yes, the closer you get to retirement. So we just made up this example. What would a 25% correction look like? Would it delay your retirement? The purple line there is the S&P 500. We're looking at a 15-year period here from 2000 to 2015. And you can see the market went down, the market went up, it went down, it went up. But what if we took half of the risk? So what if you had just half of the downside, but then you only had half of the upside? What you can see kind of with that green line, you actually end up ahead from a standpoint, limiting volatility on the downside becomes more and more important. And one of our sayings here in retirement, you win by not losing. That's really true leading up to retirement as well. We're trying to avoid the big down year because it's much easier to dig yourself out of in this example, a negative 24% year than it is a negative 47% year.
So why would you consider hiring an advisor? Emotions are a big component. The psychologists have told us when people have made money, mistakes get more costly as you do approach retirement. Typically, this is where you've had the most money in your lifetime. And again, making a mistake can have long-term effects. Stress reduction, more investment options, including alternative investments, individual bonds, strategies for additional income. But what's possibly the most compelling reason is, and this is from a study over a number of years by one of the major mutual fund companies, and they looked at what the average investments had done, whether it be REIT or high yield bonds or S&P 500 or investment grade bonds, your primary residence, what inflation was, and they found the average investor was right toward the bottom of that. And the reason for that is that people made investment decisions with more emotions. If you go to the store and toothpaste is on sale, lots of times you turn to your spouse and say, well, hey, why don't we pick up a couple of tubes? We know we're going to be needing toothpaste. Well, when stocks go on sale, it's exactly the opposite. Stocks, when they go on sale, become toxic. What if they, the mindset is, what if they go lower? What if we are having a Great Depression? And so when stocks go on sale, people typically will sell stocks as opposed to seeing this as an opportunity to buy and load those up. I'm reminded of a mutual fund, one of the formerly largest mutual funds actually in the world, where they asked the portfolio manager, what was your real disappointment? And they thought he was going to say, I didn't buy XYZ stock when it first came out, or I didn't rotate to this, get out of stocks or whatever. And he said, oh, that's a simple answer. He said, the average investor in my fund didn't come close to the average return of my fund. And we went on to explain the mutual funds can look at the average individual investor when they got in, when stocks were low, or when they got in, stocks were high, And even in this big mutual fund, well-named, well-known manager, people typically did more selling at the high. And you know, the old adage, how do you make money? You buy low and you sell high. They did just the opposite. Happy to share more information about that. But that concludes our 2 to 5 years out. And now we're going to move to retirement planning less than 1 year out. It's getting exciting. You're thinking about what retirement's going to look like. You're thinking maybe I don't have to put up with this boss for only 364 and a half days. But now is the time to estimate your retirement income needs. And you don't need to spend 8 hours looking at this, but you know, closest $1,000 per month. You'll probably want to start to look at if you have a retirement plan, defined benefit retirement plan, whether you will take a lump sum or if you've got a pension versus the pension options. Your planning will be influenced by whether you're under 59 and a half or over 59 and a half. We can talk more about that later, but your tax planning can be different. Create your retirement income strategy. How are we going to generate income? I'm reminded of the gentleman. He said, you know, it's so simple now. I only spend money on Saturdays. And he looked at us and said, Matt, Randy, he said, problem is every day's going to be Saturday. And he laughed when he said that. And so I need more money. He said, I like that pocket money, that mailbox money. How are you going to do that for me? And so we went on to explain how our plan put reoccurring and hopefully increasing cash in the mailbox on a monthly basis. Monitor your retirement plan discount rate. If you got a lump sum, how the company takes into account how they convert your monthly annuity to the lump sum. Evaluate ordinary income and capital gains tax rates. That's part of your planning. And as we said before, consider hiring a qualified and also a fiduciary-centric advisor team to help you with some of the planning and some of the decisions that are so critical as you get near this fun time. So income needs in retirement. Boy, people are all over the board here. Tell me what you're going to do. Buy a new place, travel more, make gifts to kids, pay off debt, pay down the mortgage. But we want to first sort of blow the bugle on inflation. That's a hidden tax. If you have 3% inflation, the cost of living doubles every 24 years. If you got 6% inflation, cost of living doubles every 12 years. Well, if you retire at 60 and the cost of living could double by 72, that's substantial. Then double again at 84, that's substantial. So again, planning on a real basis where you take into account inflation. If you have children, you understand my subtle attempt at humor here, the bank of mom and dad. And I've always wanted to put is always open, nights, weekends, and holidays. They never take a day off. But what about big ticket items? Are you remodeling the kitchen? Are you buying a motor home? Are you going to travel a lot? So on and so forth. But you've got ongoing fixed and ongoing variable expenses. Of course, gifts to family, gifts to charity come in. But boil it all down, typically 70 to 80% of your final salary is needed for retirement. But that varies. And as part of our planning, part of our Live Well plan, we're going to allow you a scenario that we'll mention in just a minute where you can vary that in the plan and see how the plan still works. But speaking of income needs in retirement, Matt, is 3% the new 4%?
Yeah, 4%, that's everyone's heard of the 4% rule. It's a good study that started back looking at the 70s, the 80s, the 90s. And it's a backwards looking study. Most of the years of data came when interest rates were higher than they are today. Obviously, the interest rate landscape has changed dramatically just here in the last 12 months. So this slide was even more valuable maybe 12 months ago, but we think it's a pretty compelling argument to just at least ask the question as it pertains to your personal situation. Should I consider 3% instead of 4% based on interest rates being lower than this study that's been done over multiple decades? There's a few specific things that will go in for every family, a few general things as well. One of the general ones being, at what age are you retiring? a 56, a 57-year-old probably can't spend as much as a 68, 67-year-old. Just from a standpoint, you need an extra decade of retirement spending built into the plan. So this is something that we touch on. We use what we call Monte Carlo simulation. We're actually showing families going through retirement 1,000 different times, and it really helps us fine tune and answer this question for each family. What percentage can we take out of the portfolio and feel good about it over the long term?
I think, Matt, that Monte Carlo simulation is critical. And sort of to cut to the chase, we like a flexible strategy. When things are good, perhaps take out a little bit more. When things are not as good, maybe you cut that back. But we're after clarity, comfort, and confidence. And again, if we do our job with that Live Well plan, a powerful tool to have in your back pocket, and then give you the ability to do play the what if game, you're going to feel better about what you're spending and enjoy it more. Talked a little bit about this. If you have a company defined benefit plan, congratulations. There's pros for the company pension. There's pros for the lump sum. There's cons for both as well. Questions consider. How long do you think you're going to live? What does your health look like? Do you have outside assets that are not in the IRA/401k? We see over 90% of people historically have taken the lump sum as an inflation protection, especially if they can get a good spread between where the discount rate is, gives flexibility, potential inheritance for the heirs. Again, as I said, inflation can be your worst enemy, and estate planning flexibility. But for that, you need to have an investment process. For that, you need to run the numbers, look at the math, and again, be aware of your options and how that would work out for your situation. We'll do this as we sit down with folks and give you feedback for that. If you're less than 59 and a half, you say, well, I can't retire because there's a penalty if I take money out pre-59 and a half. Not if you do a one-time distribution, not if you utilize what's called 72T. You could also use a line of credit or do a little post-vocational retirement work, or sell some after-tax assets. But there's more than one way to skin the proverbial cat. And again, as we sit down with folks that are less than 59 and a half and want to retire, where there's a will, typically there is a way. Matt had a great point. The spending, when you retire early, you could be retired more years than you were working. So again, it's even more critical to look at the planning if you're retiring before age 60. But dividends do matter. And Matt, tell us about dividend stocks and what that's looked like over the long haul.
Yeah, people think, well, it's just a 1 or 2% dividend. It's not a big deal. But we think dividends are one of the foundational principles of how we invest money for retired clients. Here, what we're looking at is a chart broken out by decade. The bluish portion is the percentage of the total return that came from dividends. And this data is updated every few years. Pretty much over the long term, though, the numbers haven't changed. It's about 40% of the total return has come from dividends, which is a real material number. We're a little bit of geeks, and we really focus on certain type of dividends. And what I mean by that is we're not always looking for the highest paying dividends. We're looking for companies that we think have a propensity to increase that dividend year over year. And if you want to boil down how we select companies to oversimplify it, a growing dividend is the most secure dividend when we look back at history or statistical data. And so that's really what our process is predicated on, not just dividends in general, but growing dividends is the thesis to how we look to invest.
Well said. We love dividends, and again, one of the advantages of is increasing income. The other is dividend stocks typically carry a lower risk level volatility, if you will, than growth stocks. And anyway, again, one of what we think is the price group's secret sauce. So we get a question on a regular basis. Well, I'm just more comfortable in cash or CDs or bonds. Well, here's an interesting sort of picture that's worth 1,000 words. The period from 1928 to 1940, government bonds, the Treasury bonds did very well. We're looking at long-term periods here. The Treasury bond from 1928 to 40 averaged 5.6. And then you get into a period 1941 to 1960, again a long period, a period of inflation, and the Treasury bond had a negative rate of return. These are real returns. You take the nominal return that you're getting on your interest and subtract inflation from it. In the case of this long-term period, 1941 to 1960, you had a negative rate of return. 1961 through 1980, oh, wow, negative rate of return again. And then 1981 to 2000 had a very high positive rate of return. If you remember what was happening in the early 80s, money market was up around the 20% level. The 10-year U.S. government bond was about 15%. And over that long-term period following 1981, interest rates went in one direction, they went down. Here we are, 2001 to 2022. You've seen a positive, albeit not that great of a positive. And so we think that fixed income is very important. We own a lot of fixed income for our retired clients. And it's on a flexible basis. It's not just a set it and forget it. We think fixed income investing takes a process, but again, where you are when you retire can be very important. And so again, picture worth 1,000 words here on what some people would say are really safe bonds. Matt, we need a process, whether it's fixed income or stocks.
Yeah, and this alludes to your example earlier, Randy, looking at historically how retail investors, people who are not running endowments, foundations, pension funds, etc., how they have reacted in the past. And so what I want to draw your attention to are the two drawdowns shaded in red. The grayish, or maybe the blackish looking line is the S&P 500. And the bluish colors are when people are adding to stocks, when the line's moving up. But in the two isolated categories here in the red rectangles, when people are selling stocks. And what you can see, everyone as a whole, on average, sold stock at the wrong time. The end of 2002, when the market was down for 3 consecutive years. At the end of 2008, early 2009, when the market had been down over approximately 50% from peak to trough, selling stocks at the very wrong time. So having a process is important. Knowing what you own and why you own it is also important. And these are what we think is the keys to success over the long term, is creating that investment process, Randy said, for the fixed income, but also for the stocks that you might own in retirement.
So why do you need an investment process? Everyone should have an investment process for stocks and for bonds, especially if you're close to retirement. So how much can you spend in retirement? How do you invest your retirement portfolio to meet your specific needs? As we've talked about a little bit, investors make poor financial decisions when they're stressed out. They let their emotions get in the way of sound reason. And that's the reason that people sold stocks at exactly the wrong time, when historically looking back, they should have been buying stocks as opposed to selling stocks. We help each of our clients with discipline and income generation. Those are core principles of the Price Group, our process-driven investment strategy. Process-driven means it's more repeatable. And our goal is to preserve client assets and generate income and also growth to meet the objectives with clarity, comfort, and confidence. But Matt, a lot of planning still needed post-retirement.
Yeah, so one of the first things we like to do as someone is approaching retired or has retired is we like to stress test their portfolio. I said earlier in retirement, one of our mantras is we win by not losing. And let us explain what that looks like. Uh, Intuition might lead us to believe, well, if we're down 20%, I just need 20% to get back to break even to where I started. But not so fast, my friend. What we see here is if we have a 20% drawdown in your portfolio and you're taking out 4% a year with some inflation, a 3% inflation rate, you can see that you need a 36% rate of return just to get back to where you started. And so this is why we are adamant that controlling risk, we said it in the 2 to 5 year section, becomes a lot more important because we don't want clients to get behind the 8 ball and start out not where we really planned for the duration of their retirement. So very, very important here on stress testing the portfolio. A big part of this is how many stocks you own, but another big factor of this is what types of stocks you own. And a good litmus test for how risky your stocks are, go back and look at how they performed most recently in a down year, 2022, and that gives you kind of a good indication of how risky the stocks are that you currently own.
Well said, sir. So a few planning ideas for consideration as we move toward the end of our time together. We typically will hold assets generating income in your qualified accounts, your IRA type accounts. We're big believers if you're making charitable contributions and you're 70 years or older, that you will send some money from your IRA directly to the charity. It's called a qualified charitable distribution. This helps save on taxes. If you don't have an IRA and have some appreciated stocks, we're big believers in, again, charitable planning from a standpoint of gifting that appreciated security. We spend a lot of time determining where it is best to take distributions for retirement. That can have Medicare, that can have Social Security implications. We are big believers in considerations of a Roth conversion, and planning in retirement should be benchmarked against goals. When you have a plan, when it's written down, it helps with clarity. Clarity leads to confidence. Confidence leads to comfort, which brings us to creating a live well plan.
So Randy's kind of like a old Baptist pastor. He loves his 3 C's: clarity, comfort, and confidence. Our promise is this: if you were interested in kicking the tires, we're not going to try to sell you anything. We have the heart of a teacher here at the Price Group, so we'll do our best to educate you on your own personal situation. And we think you'll leave a more educated consumer as it pertains to your own personal finances going through this process. So no cost or obligation. We'd be happy to set up a meeting, do that virtually or in person. But with that, Randy, I'll let you, we do have a few questions here, but
Okay.
I'll take the first question, and then Randy, I'll let you take the second. The first question: if you choose the annuitant option from the company, what happens with monthly payments if the company runs into financial problems and files for bankruptcy? It's a great question. We've seen it happen with a few different companies over the years. Most companies carry pension insurance. Typically, that does not cover everything. It covers a majority of your pension payment, but not everything. These companies can also have, some of them have supplemental or backup insurance for the entire amount, but that's, I wouldn't say the norm. So we've seen it where the pension values have been cut only to the insured value. But there's a whole host of different things that can happen. That would be, and I think we listed it, a pro to taking the lump sum. The money is out of the company plan and it's in your own hands within an IRA, which takes that specific risk off the table. The second question here, Randy, I'll let you have it. I have some money at Fidelity in an IRA. What's the difference between your group and maybe just the gentleman that I'm working with at Fidelity?
Okay. Got it. So we think it's a good idea to kick tires as you get for retirement. Again, from going from accumulation phase to the distribution phase. We are a specialist in the distribution phase. A lot of the mutual fund companies, Fidelity included, have some very good mutual funds. Many times when you have an account there, your 401k, your IRA is populated with more of their funds than perhaps the best fund in that category. What services do you need? What services will you provide? What we found is there's substantial turnover in people. Lots of times they go to the mutual fund companies as a right out of school without a lot of experience, and they end up leaving or going somewhere else. And so we think you need a fiduciary. We think you need a team effort. We think you need specialists. Think back to the persons that is you have some heart issues. You want a guy that does hearts Monday, Tuesday, Wednesday, Thursday, Friday, not gallbladders on Monday, knees on Tuesday, hips on Wednesday, and hearts on Thursday if you do have any heart patients. You want a specialist and a team that's seen this situation, these circumstances, this planning before, acts as a fiduciary and has your best interest in mind, and knows you by name, and you can come around and talk to them Zoom or in person on a regular basis. So we think a really big difference. As we sit down with people, I tell folks, you tell folks, Matt, if there's a common ground, we'll both know it. Again, no cost or obligation. And if there is common ground, we move forward, get deeper into the planning. But something you said really resounds. You got to have the heart of a teacher, and we do that. This is the price group, the 5 of us. We are adding a 6th person here this spring, and we would welcome you to reach out with any questions, any comments. There's email, there's phone numbers. That's Tiffany, that's Matt, that's Randy, that's Maddie, that's Melissa. And so I think the trains have run on time this morning. We so appreciate you taking a few minutes with us. We want to be a resource for you and your retirement needs. So again, email, phone call for that. And we'll hope to see you on one of our periodic webinars in the near future. Have a great rest of the afternoon. Thanks again.